So this is the Alvarez Corp, and I'm going to ask you to just look at the, pull up the notes on this and be referring to them, and because they're obviously a lot neater than this. But I want to just show you the setup of the worksheet, and then we'll work through how it works. So the first thing to notice is that you've got beginning balances here on this side, okay? And you've got your ending balances on this side. So if you're given a problem, a lot of times they might give you the comparative balance sheet. In other words, they'll give you the comparative balance sheet, they'll give you the income statement, and then ask you to set up the worksheet. So what's important to note, the first thing, is that on a balance sheet, the most recent year is going to be the closest column on this side, and then it's going to go back. And so you want to make sure that you're taking the beginning year over here and the ending balances are here. It's set up just the opposite. When I first started doing these, it's very sad to get to the end of the problem and realize that you've put the beginning balances where the ending should be. That's why I mention it, just to save you a little time and aggravation. Okay, so the first thing is you got your beginning balances, your ending balances. Then you'll notice that we've got debit balance accounts listed separately from our credit balance accounts. Okay, so when we're setting up a worksheet, you've got all your cash, accounts receivable, inventory, land, equipment, all debit balance accounts in that spot. Then your credit balance accounts, the accumulated depreciation, all of your payables, your common stock, your retained earnings, are all in the credit balance accounts section. So that's how it is set up. And then the bottom of it, you'll just have to imagine that this is all down here, is the statement of cash flow effects. And here's where things sort of, all of the information that we gather from the top part is kind of going to fall out down here to give you all the information you need to prepare the actual statement of cash flows. So that's the basic setup. All right, so let's start. I have a process that I use to do these, and you can do it my way, or you can figure out a way that works better for you. I tend to take it in sort of a, I think it's maybe a 3-step process, and I just start with the current accounts, because the current accounts, we can look at the beginning balance and the ending balance and sort of see what happened and make the appropriate entry for what happened in the top part of the worksheet, and then we have to put it in the right spot in the bottom and make the opposite entry there. Okay, so let's just try one. Okay, so cash started at $22,000, it ended up at $63,000. That would indicate that cash increased by $41,000. Okay, so that would be a debit entry in the top part. We're going to make a corresponding entry, a credit entry down below, and where the cash goes, we'll get our 2 columns going here. Where the cash would go down here would be change in cash, $41,000. All right, so that's where your cash goes. And that's the only adjustment we make to cash. Okay, other current accounts, accounts receivable went from 76 to 85. That's a $9,000 increase. Okay, so now here's where we have to know accounts receivable. These are all our current accounts, so these are going to end up in the operating section, right? Operating activities. So we're going to go to the operating section, and remember the first item that we really want here is net income, but we'll get to that later, because we'll get to that later. Okay, so now what we've had is an increase in accounts receivable. So we can simply say we had an increase in accounts receivable. It's a debit entry here, it's going to be a credit entry over here. These credit entries translate to adjustments down on the statement of cash flows, okay? All right, so now the next thing, inventory went from 189 to 170. That's a decrease of 19,000. So that would indicate a credit and also a current account So we would say we had a decrease, we go to the operating section, the inventory, and we made a credit entry here, so it would be a debit entry on the debit side here. All right, what other current accounts do we have? Land and equipment are long-term assets, we have to save those for later. Accumulated depreciation goes with those. Oh, accounts payable, that's a current. Now this is why our credit balance accounts are separate. Accounts payable went from 47 down to 39. Because it's a credit balance account, to show a decrease, that would be a debit entry of 8,000. Okay, so 47 minus 8 would give you the 39. And so we had a decrease in accounts payable. This was a debit here, so it's going to be a credit over here. All right, so far so good. Okay, so we did the current assets and the current liabilities. Let's take a look now. I kind of work through the rest of the accounts, and to do this, you have to refer to the additional information. So a lot of times I do the additional information next, and the additional information says net income for the year was 93,000. Okay, so where would that go? Well, retained earnings. Net income increases retained earnings. So we would have a $93,000 credit to retained earnings because net income increases retained earnings, and that would be a credit entry. Now, what we're basically doing here is recreating the journal entries in our head and then posting them to the worksheet more or less as is. So here's the credit. The debit goes up here in the operating section of net income of the 93,000. So how this is going to work is in the operating section, we're going to have the net income, we're going to have, these will be all the adjustments to net income, and then we'll get the cash provided or used by operating activities, if you remember from going over the format of the cash flow statement. Okay, so we got net income. Cash dividends declared and paid with 35,000. Well, those decrease retained earnings. Okay, so there's that. So that would be a debit to decrease retained earnings. Now, paying dividends, we have to think here and say, oh yeah, it's not an operating, it's not a, that's a financing activity. So we would go to the financing section and just say what we did. We paid some cash dividends, and it's a debit over here, so it's going to be a credit over here. And if you start thinking about it, the credits here are going to be adjustments down in the operating section, but they're going to just reflect cash that went out in the other two sections, and the debits are going to reflect the cash that came in the investing and financing sections. Okay, so bonds payable redeemed for cash. Let's look at our bonds payable. Okay, so 50,000 were redeemed for cash. So to explain what happened in the top section, we would have to make a debit entry of 50,000, because 200 minus 50 gives us 150. And then bonds payable, long-term liability, financing. So we would go to the financing section and just tell what we did, redeem bonds payable. And we did a debit here, that would be the debit side of the entry, so it would be a credit. And if we think about it, it makes sense. Cash went out because we bought back the bonds. Cash went out because we paid the dividends. Okay. What else? Common stock issued for cash. So here's common stock. It went from 174 to 216. So we issued 42,000 shares of stock, which would be a credit, because we go 174 plus this gives you 216. Okay, common stock, stockholders' equity, financing. Okay, so we issued stock. We just say what we did. We issued some common stock. Now, it's the credit part of the entry is here, so this would be a debit. And if we think about it, yeah, cash came in because we issued stock, we got the money. All right. It says no equipment was sold during the year. Okay, so let's look at equipment. Oh, it went from 200 to 270. If none was sold, it means we must have bought some. Okay? And so this is where you kind of figure that out. So you go, okay, so we bought 70,000 worth of equipment. The other side of that, equipment, long-term asset, investing section. So go to the investing section, we purchased equipment. Okay, the debit side of the entry is here, the credit side is here. It makes sense, we had to pay the money out to purchase the equipment. Okay, land was sold at its original cost. Translation, that means there's no gains or losses on the transaction. So we sold, it went from 100 to 75, we must have sold 25,000 worth of land. Land, long-term asset, investing section. So we sold land, we just say what we did. And the credit part of the entry is here, and the debit part would be over here, and that makes sense because we got money when we sold the land. Okay, so now, we did the current assets, current liabilities, we did our current accounts. We went through the additional information and sort of have everything so far. And then the third step is to just kind of check across and make sure we didn't miss anything. So you go 22 plus 41 gives you this. Accounts receivable, that looks good. Inventory, the 189 minus that. Land's okay, equipment's okay. Oh, 32 to 66 on the accumulated depreciation. We have to figure out what happened there. So if we think about that, the depreciation expense, did they not give us that in the, you think on a first problem, did they didn't give us the depreciation expense. If I were doing this, if I ran the world, I would have given you the depreciation expense since it's the first one we're doing, but they didn't, so we gotta figure it out. So if we go 66 minus 32, we know that there must have been a journal entry, depreciation expense, accumulated depreciation made during the year. So that means that, okay, we had the accumulated depreciation and depreciation expense must be 34,000. So depreciation expense, it's an income statement account that goes in the operating section, and what did I say, 34,000. And the other side of that entry would be the accumulated depreciation, the credit of 34,000, and that would explain what happened there. Now we'll go through the rest of the accounts, and 47 minus 8 gives you this, and everything else looks good. Okay, so now we can add everything up, all right, and when we add everything up, let's see, we would get 426 here, we would get 385 here, and when we put this in the right spot, 41,000 change in cash, they should both total that 426. Okay, now I do not have room to show you the next step that I added just because I think it makes life a lot easier, so look at your notes to the little yellow section. What I do is I just sort of do the totals that you're going to need for the statement of cash flows. So we start with the, in that extra column, you'd start with the net income of 93, and then you would go, okay, so plus these are all the adjustments, plus 19, plus 34, minus 9, and then minus 8 would give you sort of a adjustments of 36. I don't know if I can't really squeeze this in over here, but I'll try it anyway. So we'd have 93,000, and then with the adjustments, it would be 36,000, and so we would get total cash provided or used by operating activities of 129,000. Let me make this loop out there, okay? So that would be the first part of it. For the investing, you just go 25 minus 70, and you would get a total of cash used by investing activities of 45,000, that would be negative. And then you'd go plus 42 minus 35 minus 50, and you would get your total for the financing activities used by financing activities of negative 43. Okay, when you add this number, and this number, you should get the change in cash. And that's how you know you did it right. Okay, so let me know if you have questions on any of this, and I'd suggest there's a blank worksheet provided along with this one that you could kind of work through it if you would like to. The next ones just get a little bit more complicated as we go along.